Welcome to the Leafy Podcast, helping real estate investors and entrepreneurs grow. Say hello to your hosts, Jennifer Goglorick and Brian Price, founders of Leafy Legal Services, teaching you how to protect your assets, grow your business, and manage your wealth. Let's start the show.
Hi, everyone. Welcome to Leafy Podcast. Thank you so much for joining us today. I'm Tammy, the podcast manager, and today as our host, we have Jennifer Goglorick, the COO of Leafy Legal Services in the asset protection and real estate investing structuring business. So she has an awesome guest for us today. So I'm going to go ahead and pass it on to Jennifer so we can get started. Hey, Jennifer.
Hey there. Okay, so today's guest, in his first year of work, he generated over $70 million worth of loans for a small financing company in his first year. He got his broker's license, went on to be a partner within 6 months, and he's based out of Lakewood, New Jersey. Now, in his career, he's assisted clients in saving millions of dollars on taxes through cost segregation. I know we've used that buzzword before here, you Leafy podcasters, and we're going to find out about cost segregation from the cost segregation king. He is the national cost segregation leader with Madison SPECS. So let us welcome Yonah Weiss to the show. Welcome, Yonah.
Thank you for that introduction. That was something. Quite.
Yay. Well, we're excited to have you on. Okay, so if you're just, we get this all the time from trying to work with investors to protect their assets. Like, I just want to save some money. Oh my gosh, the taxes are going to kill me, especially people who come to us from the old fashioned way of doing the real estate business, which is just stacking all these LLCs. Well, that's unsustainable. So they've got this massive burden before they get to us, and we streamline them of this business that's become unsustainable, and so they're looking for cuts. And so Absolutely. I actually was on LinkedIn, how Yonah came here, and I saw one of your videos, I believe, and it took me to YouTube, and I just sat there like this the whole time going, I need to know more about this. And so I was like, how do I know more about it? If he's the king, let's see if we can get him on the show. So with a little wheeling and dealing, now Yonah's here. So tell us, how did you get into be the cost segregation king from going from loans for people?
It's a great question. The answer is really simply the team. So I work for the biggest national company, Madison SPECS, that does cost segregation, and I would know nothing about the subject if it were not for the company that's actually doing the operations and the work that they've been decades in the industry. I have a very good talent for learning things fast, and I have a background in teaching, which actually allows me to be able to understand very complex concepts and be able to give them over and teach them. So being an expert has really come from learning from the experts and just putting myself out there. And there's not most of the people that are involved in the industry are either accountants or engineers who are no offense, but a little bit boring sometimes.
So accountants and engineers. Yeah. No, love you guys. I work with accountants and engineers all the time.
I love them too. I work with them, but I've kind of taken the role of providing value and, sharing with the world the concepts that really everyone needs to know about.
Okay, so walk us through it. So this is our typical investor. You have anywhere from you're just starting out, you're doing wholesaling or flipping, and you're wanting to get some buy and holds. And even now with everything that's happened, buy and hold is still a great strategy. Cash is king. There's many ways, you can do it. And so then we have investors that have several multifamily, they've got a syndicate, they own a bunch of quads, and and they've got a huge portfolio. Every single one of them wants to know, how do we save money on these assets? So talk us through what cost segregation means. If I'm just brand new going, what is this? Tell me, what is it? How can we do it? Besides call you, and give me a little lowdown on it.
Absolutely. First things first, I want to touch on something even before I describe what cost segregation is, because it's depreciation and it's advanced form of depreciation. But before I get to that, I want to touch on the fact that in the real estate business, there are many different types of roles you can have. And as you mentioned, someone's a wholesaler or they're a fix and flipper. And those types, or a broker, for example, those types of jobs have usually the highest income tax rate that's out there. However, real estate benefits come into play mostly in the buy and hold strategy, because with that, you get this deduction called depreciation. And that is what this is all about. So I'll give a background on what depreciation is. So even if you are a real estate, a wholesaler, or you're, a broker, or you're doing fix and flips, you can still couple that with buying investment properties that can produce these cash, basically cash write-offs, tax write-offs that allow you to keep your cash flow instead of writing a huge check to Uncle Sam every year. So this is really how it works. Break it down. Depreciation sounds negative, right? Sounds like something's going down in value.
Right.
It's a tax terminology, and it's a borrowed term. What it means is the IRS gives you a tax deduction based on the principle that your property is going down in value as time goes on. So this is really important to understand. Your property is probably not going down in value. It's actually probably appreciating. It's probably going up in value. But when you buy a building, doesn't matter when it was built, doesn't matter how long it's been around for. When you buy that property, the day that you buy it, you start over this whole depreciation schedule, which means over the next 27 and a half years, you can take a tax write-off for the entire purchase amount. Okay, so if you buy a building for $1 million, you subtract a certain amount for land. Land never depreciates, but the rest of it, you can literally take a tax write-off. Okay, $1 million, and you get to deduct that over the next 27 and a half years, but that's a long time to wait.
That is a long time to wait.
And
go ahead.
You're getting about $30,000 a year, right? In that scenario per $1 million. So it's about 3% approximately. If it's a commercial building, it's over a 39-year period. So excluding multifamily is still considered residential. But what this means is the IRS is giving you all these tax deductions. What we do in cost segregation is an engineered approach to the tax write-offs of the building, which is written down. All of these laws come straight from the tax codes. The IRS said, yes, you can depreciate the property, you can take a tax write-off, but there's actually assets in the building that depreciate at a faster rate, which means they can take those tax dollars and keep them in your pocket. You take bigger deductions in the earlier years of ownership. That's as simply as it's put.
Well, that was a really great way to put it. And I had another guest that came on the show who all he talked about was cost segregation. This is after I found out about it from you. So I'm like, okay, all these big wig people are talking about this because he's a huge investor. And he said, let me just tell you what taxes are. Taxes are a fine by the government for you not doing what the government wants you to do with the money. And so when you think about why you would get depreciation early, even though your value is appreciating, well, there's things that go bad. So they want to give you the money back because repairs. So let's say you take those cost savings and then you reinvest that. Well, now you're helping the environment. You're becoming a smart home. They want all those things to happen. You're upgrading the windows or your air conditioning unit to be better SEER rated. You're keeping property values for everybody else, and instead of just being crushed under taxes, and then you own a hovel within 6 years because the elements come in. So they have these very creative ways. Well, how can we help them out? And investors who sometimes don't always get the best renters, who kind of tear it up a little bit, they're going to need a little bit more help from us. So again, if you're paying this money, you're actually paying a fine for not doing what you're supposed to be doing. That's best for you and everyone else in the long run. So it's just another kind of way to look at taxes to where you're not just on it. But
exactly. No, and I think it's a great, in corporate America, we're brainwashed to think that when we make money, we automatically have to have it deducted from our paycheck and give it to the government. But in real estate, it doesn't work like that. In real estate, you make the money, and if you have deductions at the end of the year and expenses that are greater than the amount of money that you made, then you actually have a negative balance on paper when you have all that cash in your pocket.
Yeah, because then you can take that cash, you can invest it in something else, you can improve those properties, and
Exactly.
you're basically making the world a better place. If you just get into business and you get completely crushed, well, then it's shown that it's just going to create blight. And we see this blight in other countries. That's exactly what happens. You finally get something, and then taxes, and then things break, and you can just never get ahead. So when you work smarter and tax smarter, it's better for everyone in the long range. But let's talk about actual dollars and cents.
Sure.
So give us a specific example of like an average single family home investor, and he's got 2 properties and they're both $100,000 properties. I don't know. Can you talk me through how much tax they would pay as if they would cost segregate, and what they would actually end up being able to utilize?
Absolutely. So typically speaking, I'll break it down in the numbers, but we'll see shortly that the more expensive the property is, the more money put into the property, I should rather say, the more it was purchased for, the greater the greater amount of deductions you have, because this is really a percentage that we're leveraging here. Okay, so typically for $100,000 property, single families happen to be the properties that have some of the least amount of tax benefit when it comes to consolidation. We talk about multifamily or other type of commercial properties have a lot more, and simply because of the assets inside. So let's break it down. Consolidation says that, as I mentioned before, personal property or things in the building depreciate faster. So anything that's not part of the structure of the building, we're talking about furnishings, furniture, equipment, carpeting, even though it's seemingly part of the property, but any type of floor coverings or carpeting is actually removable, depreciates on a 5-year schedule. All this stuff, fixtures, window treatments, you name it, all kinds of lighting in the building. The more units you have, the more of that stuff there is. So
so like window treatments, that's an interesting one, because
blinds, shades, all that stuff.
Yeah, that's interesting. Go ahead. Sorry.
Yeah, and you'll have even light fixtures and things like that where you wouldn't even think about it. Cabinets, okay, countertops, all that stuff you can write off on a 5-year schedule. And with the new tax law, you can actually take all that amount in the first year. So typically in a residential property, single family or multifamily, it's typically between 10 and 30% of the building can be allocated to these assets. So we talk about, the engineer will come in and say, hey, there's 20,000 square feet of carpeting, right? Or in a single family, 1,500 square feet of carpeting. And there's, these cabinets, how much footage of the cabinet, and they give a price amount, they break it out, they price everything to industry standard prices as well as regional standard prices for those assets, and then make a calculation of what would it cost to rebuild, what's the replacement cost, what would it cost to rebuild the property, and kind of reverse engineer the property, saying this $100,000 property is going to have, $10,000 worth of equipment and furniture, et cetera. You can take that all in the first year or spread out over the first 5 years. So again, 10%, 20%, the greater the property value, the more benefit there's going to be, because the more write-offs you can have.
Well, yeah, that's how it goes for business or anything else. The more lucrative, you're going to have more things. Well, that's really interesting. That can save a lot of money for someone over time. So what, on average, when people come to you, do you have like any stats? Like, let us do this for you, and we can save you between blah, 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 blah.
Absolutely.
Those are not actual numbers. Blah,
yeah, well, blah, blah, blah is, that translates in accounting to, a lot of money.
Right.
We always run like a free estimate. So we'll look at the property and look at some components, some details about the asset. And our engineers, since we've done thousands of these, we have a lot of experience just looking at some of those details, what's the square footage, how many units, et cetera, to be able to tell what your potential tax savings are going to be. So we always run that free analysis up front, and that right off the bat, what is your tax savings going to be if you run a full cost segregation study. So it's really a no-brainer. It's very educational. You see, does this make sense? I'll see the numbers. If I took regular straight line depreciation, meaning taking that 3% of my property value every year as a tax deduction, I would get on a $100,000 property, maybe $3,000 deductions per year. But if I'm making $10,000 from the property, okay, what $3,000 of tax deductions looks like is I only pay tax on the remaining $7,000. However, with cost segregation, you may get a $10,000 deduction, right, each year in the first 5 years. So by front loading that depreciation to those earlier years, what that means is on your $10,000 of income, instead of paying taxes on the 7, I'm going to pay tax on 0 because I've created and front loaded those deductions. So, and this obviously translates
exponentially for someone else. So, like I was thinking one customer's house that we has 4 12 plexes that they were able to get. So something like that, and they don't want to be in it. They have a 3 to 7 year plan to hold on to these because they have a lot of interest and they just need it for right now. So why would you pay taxes on that one part? If you can front load those taxes, you get to keep the majority of the deduction, and then you're able to flip that property, take the money that you've earned, that you've socked away, and then invest it into a much larger multifamily deal, or go from single family, saving that little bit of money that you've made. Like, think of yourself, okay, I'm still going to sock this tax money away as if I were paying it, and I'm going to put it away. I'm going to put it away in my solo self-directed 401k, right? And I'm going to start making money on that. And then at the end of this term, when I do it, I'll have all this extra money that would have went to taxes. Right. And now I'm going to use it tax-free to invest in something else. It's a really great strategy. Absolutely.
Absolutely. So this is something that, people don't realize, that when you're actually making money and the government is incentivizing you or trying to incentivize you for investing in real estate, take advantage, right? Take those tax deductions, use that money, because why would you give Uncle Sam money when he's telling you you can keep that? And I always like to quote Tom Wheelwright, who is, a great author, of Rich Dad Advisors in Tax-Free Wealth. Great book. And in that, he talks in the chapter all about depreciation. He says, the rules about cost segregation are in the tax code, but the IRS does not require you to do it, even though it's considered the proper way of depreciating your property, to take those deductions earlier on. But they don't require it. Why? Because they assume that because of the laziness of a taxpayer and their accountants, it just creates more revenue for the US Treasury. So why would they go ahead and tell you to do something and require it when they can actually, make more money?
Right. So there's this really push-pull, because if I told most people, you know how people think about the government and the IRS, if I said the government will incentivize you to purchase real estate and be an investor and to do that, they'd be like, yeah, right. But actually, for savvy investors, there's all these different perks and all these different things. And when you think about, from the president of the United States on down, where did they make all their money? Well, they made it in real estate, but they were smart about it. You want to be smart about it. There are things that are there. And so it just takes a call. So let's say you right now have a couple of multifamilies, or let's say you're just starting out and you want to cost segregate. You just need it for whatever. Then they go to you, right? So they'd go to madisonspecs.com, and do they set an appointment to do a cost analysis? And then how does that work?
Yeah, like I said, we always send a free estimate first. So you can just look at it. You can discuss it with your tax advisor. We're not an accounting firm. We specialize in cost segregation. So we work together with your accountant. We're not trying to become your accountant. And accountants who are savvy in real estate will understand this and know about it. However, a lot of them aren't proactive enough to tell you that you should be doing this because they cannot facilitate it themselves. They're going to have to hire out a third-party firm like ours to do it. So take that, discuss it with your accountant, and then when you come back, yes, we'll arrange a site visit for one of our engineers. We will conduct this study, which is typically, we'll come and take pictures and measurements about everything in the property, and come back, create this report, which produces an updated depreciation schedule. And that's really what you need. You just plug it into your tax form, your tax return, and you're good to go.
Bing, bang, boom, you're done. You're saving thousands of dollars and saving money on taxes. And then you can take that money and be, very abundant, which is what we all want to be.
And create more wealth with it. Exactly.
Yes. Okay. So we've been talking to Yonah Weiss, and if you want to learn more, and of course we're all going to want to learn more, just go to Madison SPECS. That's MadisonSPECS.com, MadisonSPECS.com. and give Yonah a call over there. So before we end, can you give us like any idea of moving forward? Like, we're coming through this unstable period and blah, blah, blah. So we're all going to want to save money where we can. So it's going to be important for people to contact you, because everybody's going to be, we're all kind of like reeling, we don't want it to be, we don't want it to even be a recession, but it's a recession. But I think we're going to come out of it soon. But what are your thoughts on moving forward with this? And can anyone use cost segregation? Or is it really just geared for people who have a lot of multifamily? I mean, can just regular people who have maybe 1 or 2 Airbnbs do it? Is this for anyone?
It can be for everyone, but it's going to really depend on a few factors. First factor is that if you're considered a real estate professional. Now, that's a tax term. That's from the IRS tax code, which says that if you spend more than 50% of your time, if either you or your spouse is full-time in real estate, then you actually get to take these deductions and not only use them against the income produced from your properties, but actually you can use them to offset income from your active income as well. Okay,
oh, wow. So like if you're married and your wife is like, okay, I want to have these 3 Airbnb / Verbo whatevers, and I'm going to do all my time on that. And she's like learning all this stuff. And you have these 3 properties that you're doing that this could actually be quite beneficial for even you guys. Okay.
100%, because now you can take those deductions and offset other income as well. For someone who is not a real estate professional, maybe you just, you work a W-2 job and maybe you have a couple rental properties as well, the benefits are going to be limited to, those deductions to offset the income from those properties. So again, you will still be able to take those deductions and basically create income from real estate that is not taxed, because but it's going to be limited. Okay. So it's going to be obviously.
Right. You're not going to become a multimillionaire overnight. You're going to have to pay for the cost segregation study. Exactly. But once you start getting into doing that, then hopefully that little bit of money, that can be something you invest in now. Then you start saving that money, socking it away. And now instead of just having a couple of rental properties, you have two properties, and maybe you've gotten a quad or a duplex and in a great area that you really wanted. And then you can do that with that. And then you do that with that. So it's like one of those things, you teaching someone to fish. You've given a great tool. And if you utilize that tool, then, now we're talking. Now there's something to do. Okay, 100%. Yonah, this has been so great. I am so glad I watched that video on or LinkedIn. I hope you do a lot more of those, because it was. I do, yeah. Yeah, that's good. That's good. Okay, everybody, we're going to have to end it up here with Yonah Weiss of MadisonSPECS.com. This was great. I feel like I've learned so much. And Tammy, you're going to have to take us away. I always get sad at the end.
Thank you so much again, Yonah, for being on the show with us. And we will have all of the links to get a hold of Yonah in our show notes. And thank you again, Jennifer, for hosting today. And if you would like to look for us, we are on all podcasting platforms and also social media platforms at Leafy Legal. And if you would like to leave a comment, we would love that, or a rating. Always love all of our ratings and everything. So thank you, everybody who's been doing that. And if you do have something you would like to ask Leafy Podcast, or if you would like to recommend a guest or anything, please email me, Tammy, Tammy, at leafylegalservices.com, and I will get right back to you. Thank you, everyone, again for listening, and we hope you have a great day. We'll see you next time. Bye-bye.
Attention real estate investors and entrepreneurs. Did you know that real estate investors are a primary target for lawsuits? According to the National Survey of the Court data, 25% of Americans risk being sued in their lifetime. However, if you are a real estate investor, you have a 95% chance of being sued in the next 20 years. Leafy Legal Services helps you protect your assets and strategically grow your business and wealth. Leafy Legal Services are experts at the Series LLC and Delaware Statutory Trust trust, two of the newest and most ideal legal structures for real estate investors. Leafy Legal Services have the most personalized and affordable solutions for setting up LLCs. Property owners are always at risk when it comes to their assets. Anonymity is so important. If you own just a rental house and you own your home, you have to protect yourself and your properties from any potential legal issues. Leafy Legal Services have the right solutions to make sure you are happy and feel secure. They offer cost-effective documentation that suits their clients' needs. For a free consultation and ebook, visit leafylegalservices.com. They are waiting to hear from you. leafylegalservices.com.
Follow us on Facebook, Twitter, and Instagram.
Don't wait. Take action now. LeafyLegalServices.com. Protect your assets, grow your business, and manage your wealth.